Shalom and welcome to On the House, the podcast where industry experts and professionals discuss real estate in Israel. I'm your host, Debbie Goldfisher, real estate agent, founder and editor-in-chief of Buyitinisrael.com. Join us as we explore market trends, legal and tax issues, purchasing tips, neighborhoods throughout Israel, and much more. All this is On the House, helping you make the right move. Welcome, everybody, and thank you for joining us today for the fourth episode of the third season of On the House, dealing with money matters and financial aspects of buying a home in Israel. We've discussed how much homes cost, what the additional expenses are and the hidden costs. We've spoken about budgets and how to calculate how much you can afford to spend. We delved into mortgages and understanding how much you can borrow. And we discussed all the ins and outs of transferring funds from abroad, converting currencies, and making payments. Something else that is relevant and important to consider when making a real estate purchase are the tax implications on the buyer. I'm not referring to the local taxes in Israel. We already discussed Mas Rechisha, purchase tax, in the first episode of this season with Nadav Ellenson. As a reminder, purchase tax is a graduated tax that is applied to the full value of a transaction upon purchasing the rights to any real estate in Israel. Once a contract is signed, the tax must be paid in full within 60 days. And rates differ depending on a number of factors, which include the status, number of properties owned, residency, price of the home, and other factors. We have a great calculator in English on the Buyitinisrael website to help you calculate the tax. But what I'm referring to, and what I want to discuss today, are the tax implications on U.S. citizens who purchase real estate in Israel. For those of you in the UK, I have an episode coming up for you too. Don't worry, so stay tuned. And for today's episode, I am delighted to welcome Larry Stern. Larry is a CPA, a U.S. certified public accountant, partner at Abulafia Avital Shvensky & Co. with expertise in U.S. and international taxation, relocation issues, and asset planning. Larry has extensive knowledge of the double tax treaty between Israel and the U.S. and is an expert in complex tax planning for individuals and corporations. So with that, Larry, welcome, and thank you so much for joining us today.
It's my pleasure to be here.
Larry, you're an old friend of my husband, Barry, from Yeshivat Shalavim days, and we recently met at the high school graduation ceremony for our own sons at Yeshivat Lapid in Modi'in. And you also reached out to me recently about the tefillot for the hostages and soldiers that I distribute. And truthfully, I never knew about your secret life as a CPA. When I was discussing with Dan Eisenberg, who I interviewed last week, who I could bring on for an episode on U.S. tax implications, he said, hands down, Larry Stern. So here we are. It's amazing what a small world it is.
It really is. It's surprising. It's amazing. I've heard of you and Buyitinisrael, and it's just great to be here.
Thank you. Thank you so much. There are so many questions I have for you, Larry, and I'm sure many of our listeners are eager to ask as well. So let me try and cover as much as possible. So we have a U.S. citizen. Let's say for now he or she is in the U.S. and he makes a purchase in Israel, buys a home, plans to live here in the future, but there are no immediate plans right now. What, if any, are the tax implications in America?
If we're talking about a sale, tax implications upon purchase don't exist. There's no reporting requirement. There's no tax as it relates to purchase of a home.
Okay, before we get to sale then, so he purchases the home, there are no implications. What about ownership of the home?
So ownership of the home also, there are no specific implications. There are tax benefits similar to in the U.S. where you can deduct mortgage interest up to certain limits against your income for tax purposes.
Even if the mortgage is taken in Israel?
Even if the mortgage is taken in Israel.
Okay. What about on rental income? If he buys a property, he owns it here in Israel, and he rents it out.
So rental income, if it's being rented out, would be reportable as income in the U.S. As a U.S. citizen or a U.S. resident, green card holder, an individual is required to report their worldwide income, whether they're living in America or not. So even if they're living in Israel and own property and have rental income, that needs to be reported to the U.S. The first right to tax rental income is in Israel because the property is located here. Mm-hmm. But for U.S. purposes, one can claim expenses such as Arnona.
Sorry, Arnona is the municipal tax in Israel?
Yes, the municipal tax in Israel, although many times that's actually paid for by the renter themselves. But if the owner pays and bears that cost, those are considered deductible expenses. Broker fees, rental management fees, repairs.
Got it.
All of those would be treated as expenses and are deductible against the rental income that's reported in America.
Understood. Obviously, he needs to have formal receipts.
Preferably.
Okay.
There's also one additional expense that's called depreciation. When you purchase a property, the property itself is typically divided between the building, which is depreciable, and land, which is not. So let's say 80% of the property value of the purchase would be related to the building, and let's say 20% is related to the land. So of the 80%, one can claim for new assets put into service, put into rental at this point in time, it gets depreciated over 30 years.
Got it.
So 1/30 of 80% of the purchase cost in our example would be considered an expense against the rental income. So the amount of rental income that becomes actually taxable is much lower than the actual cash in pocket.
Understood.
Depreciation significantly reduces the tax exposure for U.S. purposes.
And if a U.S. citizen is living in Israel, are there any differences in these answers, or would it be the same thing?
No, the exact same thing. A U.S. citizen living in Israel versus a U.S. citizen in America have the same, at least at the federal level, the same obligations.
The only difference is that if they're paying Israeli taxes, then they can...
Well, they would still be paying Israeli tax because the rental income is taxable in Israel because it's an Israeli property. So in either sense, they're paying Israeli taxes. Now, there are two different ways one can pay Israeli taxes on rental income. They either can pay a flat rate of 10% on the gross rental income, so the amount of the actual rent
So if they receive rent of 8,000 shekels, they pay 800 shekels per month.
Correct. Possibility number two, below certain amounts, under about 5,500 shekel, rental is exempt. If the amount of the rent is above that 5,500, which is updated per year, then you start losing part of that $5,500 exemption amount. For every shekel above, you lose 1 shekel of the exemption. So you're making 2 shekel taxable on every shekel above
the threshold.
Right.
So we're not going to go too much into the Israeli taxes because we have experts we're going to bring on for that. We want to focus here on the U.S. implications, but that's certainly very helpful.
So from a U.S. perspective, there's one other aspect that a U.S. resident would have that an Israeli person who is an American citizen would not have, and that would be state tax, state and or city tax.
On rental income.
On any income. If they're a resident in a given state, most states, with the exception of about 4 or 5 of them, have some level of income tax. Okay? So an American that's living in America in a given state, let's say New York, California, New Jersey, Georgia, wherever, in addition to the federal taxes they pay, they also pay state tax.
I see.
And since they have to report their worldwide income to their state of residence, the rental income would be taxable in that state as well. As opposed to an American living in Israel that has likely broken their tax residency with a state when they made Aliyah. In that case, they would not have to pay U.S. state tax on the rental income from Israel.
Okay. So we've spoken about purchasing. We've spoken about ownership. Now we should talk about what happens if you sell real estate in Israel.
Before we get into the sale, just one other point related to the taxes on the rental income. If someone pays tax in Israel, they can use that tax they paid in Israel to offset against the federal income tax they pay in America. So they won't pay double taxation.
Good.
That's available from both domestic law as well as the treaty between Israel and the U.S.
And what about the state law?
Most states don't allow for a credit. There are 2 or 3 states that do allow for a credit for taxes paid to another country. Unfortunately, most do not.
So let's give an example. We just spoke about rental income of 8,000 shekels.
Sure.
In Israel, one of the options would be paying 800 shekels in tax. What sort of tax would they pay in America, and would it be offset? Would it be more or less than this?
It depends. It depends what kind of expenses and how much depreciation that a person can claim. But let's assume for a second that a person has 8,000 shekel of income, let's say 6,000 shekel of expenses with including depreciation, which is not a cash expense. It's a paper expense because you're buying the house. You're giving the money with the time that you buy the property and or take the mortgage. Mortgage interest is also a deductible expense for that purpose. Let's say that you're left with profit for tax purposes of 2,000 shekel.
For this month?
For that month. And let's say a person's in a 25% tax bracket in America. Okay. So they would theoretically owe 500 shekel of tax on the 2,000 of income. They've paid 800. They shouldn't have to pay any additional federal tax in America because they can use the 800 to offset against the 500 that would have been due in America.
Okay, that's very helpful. Let's move on to the sale of a property. And again, we're talking about residential here.
We're talking about residential. As you indicated, you're going to be talking more about the Israeli obligations on the Israeli side.
Correct.
But generally speaking, both residential and commercial would be treated the same way for someone that's not in the business of rental real estate. The business of rental real estate, the rules are very different.
But if they own commercial real estate, then it's a business.
For Israeli purposes, but it's still a passive activity for U.S. purposes.
I see. They're not self-employed
by virtue of that.
I see. So like a doctor could own commercial space and that's not his profession.
Correct.
He's just renting it out as passive income.
Yes.
Okay, understood.
Exactly. So when it comes to the sale, again, we're talking about rental income. Personal property or personal residence sales are a bit different, and we can talk about those separately. But for rental property, the sale price less the original cost basis, less any depreciation previously claimed, because the depreciation reduces your cost basis for purposes of calculation of gain. You pay capital gains rates if you hold the property for greater than 1 year.
So let's say that one more time. So
your gain is calculated as the sales price minus the purchase price minus costs of purchase, like lawyers and brokers and the like.
Minus depreciation. What about running costs? What about maintenance and repairs?
Well, the maintenance and repairs are deducted against rental income.
Got it.
So we don't have to add those to our capital gains calculation.
I see. Otherwise, you'd be doing it twice.
Correct.
I see. Okay.
So upon sale, you'd pay U.S. capital gains rates, long-term capital gains, if you held the asset for more than a year. If you held it less than a year, then you pay your marginal tax rate on the gain. In terms of long-term capital gain, it's actually split into two. There's the main component that is taxed at a cap of 20% for income tax, assuming, again, holding it for more than 1 year. 20% income tax at the federal level, okay? On the depreciation portion, the tax rate is 25%. There's obviously state tax if a person's still resident when they sell them.
I'm assuming that if this is somebody's main residence, then do they pay capital gains?
It depends, and I can go into that in a minute. But again, any tax that's due in Israel on the sale of the property can be used to offset against the federal tax that's calculated.
I see. So if you were to say, I can't say me because I'm not an American citizen, but
Lucky you.
I am, but my kids are, so that's another story. I'm not complaining. So if you were to sell your house, Larry, your house in Israel, and you move to another property, would you have to pay capital gains on your property? Potentially.
The exemption rules in the U.S. are the same for U.S. properties. When you live in and own the property you sold for at least 2 out of the 5 years immediately prior to the sale of the property, depending on your filing status, $250,000 for an individual, $500,000 for a married couple, that amount of gain is exempted from tax from the sale of a personal residence.
If you've lived in it for the last 2 years. 2 out of 5.
2 out of 5 immediately prior to the sale.
Okay.
Now, it gets a bit more complicated if the property was partially used as a rental versus partially lived in. Okay? If it was partially rental and partially lived in, then you have to allocate the overall gain based on the holding period of the rental versus the holding period of the residence. And you can only exclude the portion related to the holding period of the residence.
I think I understand that. But if you've lived in that house for 5 years.
Let's say I've owned it for 10 and I've lived in it for the last 5 before I sold it. Okay? 50% of the gain that I calculate from the sale of the property. Even
if it's your only home, that's the only house you've lived in, you don't own anything else, you have to pay capital gains
tax
after this exemption.
On the allocable portion of related to the rental period.
Unbelievable. In Israel, there's no capital gains if it's your only property.
Each country has their own rules.
Goodness.
The biggest area that people may be surprised by when it comes to the sale of a property is how the gain is calculated due to exchange rate issues. Okay? You've discussed exchange rate matters previously.
Last week with Dan.
The U.S. works on what's called a dollar-denominated basis. So it doesn't matter what the exchange rate is. It doesn't matter the currency you bought it in. Everything is calculated in dollars. Now, it could be that you bought a house for 1,000,000 shekel when the exchange rate was 4-1. So you bought it for $250,000. Let's say you sold it for 1.8 million, but the exchange rate is 3-1. You have an artificial gain because your gain that you're calculating is 600,000. 1,800,000 divided by the 3 is $600,000. You now have $350,000 of gain, even though your gain was only 800,000 shekel.
Right.
And there's no way that is the current exchange rate.
But from the U.S.
From the U.S. perspective, they look at it as a dollar-denominated basis.
Wow.
So there are artificial gains potentially.
I just want to go through something again. If an American citizen has a home in Israel, it's their only residence, they sell the home and they buy something else. In Israel, there is no tax on the capital gains, but from America, there will be taxation.
You have to understand also, and this is more on the Israeli side, an American living in America that buys a property in Israel may not have the single home exemption because they're not resident in Israel. So they may have to pay Israeli capital gains. Again, those Israeli capital gains taxes, the mas shevach, can offset against.
Right, but I'm talking about somebody who lives in Israel, a U.S. citizen that lives in Israel, lives in the home happily, no other investment properties. When they sell their home and move somewhere else,
they bought in Modi'in 20 years ago.
Okay.
They sell their property now in Modi'in. They make
profit.
A huge profit, more than $500,000. Mm-hmm. And they only use this as their principal residence.
Mm-hmm.
On any gain above that $500,000, they will pay U.S. income tax.
I've never, ever heard that in all the time I've worked in this.
Yeah. The issue about U.S. citizenship, and this is a completely different topic, but the issue with U.S. citizenship is that you basically have the worst of both tax systems. So things that are taxable in America, but not taxable in Israel, or that are taxable in Israel, but not taxable in America, you never get the benefit of the tax exemption or deferral.
Wow. Well, I guess we have to talk a lot about renouncing American citizenship.
That is a real topic of conversation. I recently did a podcast on that as well, but it's something that more and more people are considering these days. I see it significantly part of ongoing discussions.
So that raises an important point, and that is somebody like myself, for example, I'm married to an American, I'm British. Would we be better off if we bought our home in my name and not in my husband's name?
Potentially. That's one of the planning tools that we would look at for people that come to us before they buy a house or are looking to reallocate their assets or whatever it may be. One of the possibilities for planning purposes is to put the U.S. assets in the U.S. citizen's name and the non-U.S. assets in the non-U.S. citizen.
Makes sense. We also have to think about it when our children get married to U.S. citizens or to non-U.S. citizens. Very important to think about that.
Again, that perspective is mainly from a tax perspective. Obviously, there are other
legal
family law and legal implications and things like that. But from purely a tax perspective, the normal rule would be U.S. assets in U.S. citizens' name, non-U.S. assets in the non-U.S. citizens' name.
Well, okay. And I'm assuming that from a reporting point of view, you don't have to report the assets that you own. If you're not selling them, there's nothing to be reported.
There's nothing to report. The only time you would need to report them on a tax return is when there's a taxable transaction. Okay. Sometimes there are taxable transactions that people don't think are a taxable transaction. You'd probably be surprised, but the payoff of a non-dollar mortgage may create a reportable gain because again,
of the currency
exchange
rates. Interesting. Another trigger, I guess, or taxable event is inheritance. So let's think about this. First of all, somebody owns real estate and they are writing their will. Who does it make sense from a tax perspective to leave their real estate in Israel to? A U.S. citizen, a non-U.S. citizen?
Well, for a U.S. citizen, that the estate tax that applies in the U.S. is on the decedent, on the person who dies, not the person who receives the asset.
Well, if he's dead, how can he pay the tax?
Somebody's responsible for the overall assets. So, a person may have retirement plans in America. They might have an investment account in America. They may also have an asset in Israel. You have to combine all of that together when determining whether a person's estate is taxable for U.S. purposes or not. Currently, there's approximately an exemption per U.S. citizen of $13.6 million.
That is for the receiver or for the...
No, for the decedent.
For the decedent.
For the person who dies.
Okay, he's allowed to leave...
He's allowed to leave over his lifetime $13.6 million worth of assets. So if it's a couple who are both U.S. citizens, in essence, they have $27 million worth of assets before they'd be subject to U.S. estate tax.
Understood. Okay, what about from the receiving end?
On the receiving end, there's no tax for estate tax purposes on the receipt of an inheritance.
Mm-hmm.
Same thing in terms of a gift. If a parent or someone else leaves them a gift of an asset, the recipient does not pay tax.
Okay.
If there are gifts or inheritances from a non-U.S. citizen, so for example, let's say they have a family member who's only an Israeli, they pass away and they leave a U.S. citizen an apartment, the receipt of the apartment is declarable to the U.S. Internal Revenue Service, but there's no tax to have to pay. It's an informational return only.
And if the real estate is located in Israel or outside of Israel, does it make any difference?
It does not. The estate rules apply for a U.S. citizen on worldwide asset. What people get surprised about, and unfortunately sometimes I only encounter this after a person passes away, even non-U.S. citizens are also subject to U.S. estate tax.
I was going to ask this. If an Israeli receives Yerusha and an inheritance, U.S. real estate, does he have to pay tax?
Not on the receipt of the real estate. The recipient never pays tax. However, let's say an Israeli buys real estate and invests in real estate in America and then passes away, that Israeli would be subject to U.S. estate tax on the value of his U.S. property.
Because he doesn't have the exemption of 13.6.
He doesn't have 13.6. He only has an exemption of $60,000.
Wow.
Yeah,
okay.
It's significantly...
I guess that's the one time it pays to be American.
In that respect, for sure.
When you die.
It depends where your assets are. If a person has assets in America and they're American, it's great. Doesn't matter where their assets are if they're American. They have the larger exemption. But part of the planning is, like I said, the reason why we would want the U.S. assets in the American's name is because they have a higher estate tax exemption, and you're not exposing the non-American to U.S. estate tax if they were to pass away, compared to assets in Israel, where if you have it in the name of the American, they're going to be subject to income tax. So you're basically benefiting by the American enjoying whatever Israeli exemptions there are, and the non-American not being subject to U.S. estate tax.
Understood. Let's say an American has real estate and wants to leave it to his grandchildren. Does it make sense? Is there any reason why he should leave it to the non-U.S. grandchildren rather than the U.S. citizens?
Again, part of it's going to depend on what the expected value of the children or grandchildren's estate for themselves would be. For the grandparent or the decedent.
Let's say two grandchildren. One of them is Israeli and one of them is American. Same tax brackets and
yeah, it would make sense to avoid having the U.S. citizen not be subject to Israeli tax. If this is the non-American grandchild, let's say, is the one that receives the Israeli property, and that's the only property, and they live in Israel, then they can have the exemption. Whereas the American child would always have that exposure to U.S. tax.
Unbelievable.
So some people do split their assets in that kind of manner. So if they have two children, one's American, one's not, they want to give each of them 50%. So they work out a plan so that the non-American assets are given to the non-American and the U.S. assets are given to the American to benefit from each of those circumstances. Now, the one point that most people don't know is for the non-Americans and holding U.S. assets, that there are stocks in U.S. companies, whether they are held in a U.S. brokerage account or outside of the U.S., are subject to U.S. estate tax. I work for IBM, and I'm part of an IBM stock program. I'm not American, okay?
You're an Israeli.
But I'm an Israeli that holds IBM stock, or Google, or Tesla, or whatever it may be, okay? If I pass away holding this stock, and the value is greater than the $60,000 exemption, I have to pay U.S. estate tax on the value of those shares. Even if those shares are held in a brokerage account or an investment account here in Israel, it doesn't matter.
They're U.S.-based stocks.
Because they're U.S. domiciled stocks.
Maybe this is a stupid question, but can somebody become a U.S. citizen after they die?
They cannot become
Based
a
upon
U.S.
the
citizen
fact that they
after
lived in
die.
America their whole life or whatever.
Well, if they lived in America their whole life, they would likely have been either a citizen or a green card holder already. Green card holders have special rules when it comes to estate tax. A green card holder living in the U.S. typically is
As a citizen.
is treated like a citizen, whereas a green card holder living outside the U.S., which shouldn't really happen that often, is treated as a non-citizen.
Got it. That was myself, actually. I had a green card, but it expired and I'm no longer a U.S. citizen.
I hope you returned it.
I did. I learned the hard way because I had to pay taxes on as an independent עצמאית in Israel, I had to pay taxes on Social Security.
Okay. Yeah, that's...
I learned the hard way.
Yes, exactly. If I can, just one other point. Let's say an American decides to buy real estate in Israel. Did you cover previously about the need to file what's called an FBAR, a foreign bank account report?
Never covered that. Nope.
So a U.S. person, citizen, green card holder, resident, is required to declare their financial accounts, bank, investment, pension, etc. if the total highest value in the account, in all of the accounts combined that are outside the U.S., exceeds $10,000 at any time during the year.
This is a U.S. citizen living outside
Anywhere.
Anywhere.
So
in
even
America
a
or
U.S.
outside of America
citizen living in America decides to buy a house. But in order to buy a house, they open up an Israeli bank account. That bank account now is a financial account that would be required to report on this, what's called an FBAR, Foreign Bank Account Report, FinCEN Form 114, and submitted electronically to the Department of the Treasury. It's not an IRS tax form.
Okay, listing all of the accounts that sit outside of America for any American citizen, no matter what.
As long as the total value of those accounts at any time during the year exceeded $10,000.
Okay, understood.
Even for one day. So a person might have opened up an Israeli bank account many years ago, never transferred any money in, or has 500 shekel in the account, okay? Now they decide they want to buy real estate here in Israel, and they transfer $700,000 into the account. The money that's transferred into the account, even if it immediately goes out from that account to the property owner or whatever, they have to now declare that they had more than $10,000 for a single day in their account outside the U.S. on this FBAR form. The penalties for not filing it are quite serious. It's either $10,000 for the tax year, and if the IRS or if the Treasury Department finds that it's willful, it could be 50% of the highest value.
Goodness. Okay, so what's that got to do with real estate? Well,
again, people may not think about the process when buying real estate that they transfer money into a bank account in Israel. It's important for them, as far as their filing obligations to the U.S., to realize they may have to report the transaction of moving the money from America or any other country into this foreign account.
So going back to the question I had before about putting real estate into the non-U.S. spouse's name, if they have a joint account and the property is sold by the non-U.S. spouse and the money hits the account, then the U.S. citizen is going to have to declare that on his FBAR.
On his FBAR, definitely. Taxation is based on the ownership, not based on where the money goes into.
Ownership of the property, not of the account.
Correct.
Okay.
Where it could impact the U.S. citizen is that it can be looked at as a gift from a non-U.S. citizen for half the value, right? Because it's going into a joint account from the sale of the property. The U.S. citizen, if they receive a gift or an estate inheritance from someone who's not American, has the reporting requirement, assuming the value is over $100,000, they have to declare that also to the IRS.
I see. So it sounds like it would make sense to have separate bank accounts.
For investments, such as real estate, and such as stock portfolio and so on, it would make sense to have a separate account for those.
So something else that comes to mind is an IRA, an individual retirement account. I know about this because when Barry and I first got married in the late 1990s, we lived in New Jersey, and I worked at Salomon Smith Barney that was taken over by Citibank, and I worked in the retirement planning and IRA department. And I remember learning, all about the IRA and what the conditions are. It's basically a retirement savings account. And one of the exceptions for allowing early withdrawal of funds is for a home purchase, for a first home purchase. And I always used to wonder, could you purchase a home in Israel with this money?
No.
No.
The reason being that the first home purchase exemption is capped at $10,000. So the amount that you can actually withdraw without paying an early withdrawal penalty, you'll still pay the tax on the withdrawal amount, but without paying an early withdrawal penalty. If you haven't reached age 59 and a half, is $10,000. So it's not going to get you very far.
That's it?
That's it.
Was it always that much?
At least for the last couple of decades. So,
okay.
But back in the day, $10,000 could get you a lot.
That's true.
So nowadays, it doesn't get you very far, especially with down
Just
payment.
by the way, I remember you could also withdraw funds for college payments for university students.
Also limitations on that.
Can you pay for Israeli college with those funds?
Certain colleges, yes.
Interesting. Okay.
Certain colleges, yes. What's interesting about that, though, it depends on the type of IRA. If you're talking about a Roth IRA, then withdrawals may not be subject to the penalty under certain circumstances.
Gosh, you bring back a lot of memories. There were Roth IRAs and there were individual. I can't remember. It's been a while.
Yeah, it's
still around. The IRA is still a thing?
IRA is still a thing. Most people, after they leave an employer, move their 401k plans into their personal IRA for self-management. There's some very nice tax benefits in Israel associated with that.
Interesting.
With those IRAs.
You have to understand, for me, the IRA growing up was a terrorist group. Irish Republic Army.
I understand completely.
So it was quite a shock for me when I was working at the department.
IRS as being the terrorist group, but that's a different story.
Oh goodness, we don't like to talk about terrorism on this program.
No, I understand.
It's so interesting what you do. There aren't so many people in Israel, correct me if I'm wrong, that have this expertise, both U.S. tax implications and Israeli tax as well.
We're one of the few firms that actually has both a U.S. and Israeli practice internally, whereby we cross-train our team members on the U.S. side to understand basics of the Israeli side and vice versa. If you contact someone in our firm or myself to get tax advice, there generally is a view of the other tax system to be able to work on those together.
So important because the two work together, as you've described.
In particular for financial planning and for asset planning, it's really important to have somebody that can describe both the U.S. and the Israeli implications. Otherwise, you run into pitfalls where you get advice from one side and they fall upon a bad tax situation on the other. I see this all the time when people plan with trusts in America, and they have some children living in America and some children living in Israel, and how they set up their living trusts and what happens after they pass away. And unfortunately, many people don't take into account the Israeli implications of those sort of things. So
such a shame. Well, okay, Larry, we are running out of time. This has been a really super helpful session, and I feel like this is a bonus. Many, many people have all these questions and many more. And I hope that this answers a lot of those questions, addresses the issues, and makes purchasing a home in Israel that little bit easier.
Additionally, as a firm, we tend to do a lot of pre-Aliyah counseling, both for financial asset and tax-related issues associated with financial assets. And in addition, for those that are completing their 10-year exemption period in Israel, after they've made Aliyah, we also take care of tax planning as people approach their 10-year exemption. So we can help at any stage of the life cycle of making Aliyah, and we'd be happy to help.
Okay, thank you, Larry. So there you go. Even if it's not real estate related, anything to do with U.S. taxes and financial planning prior to Aliyah or after Aliyah, Larry is your man. I will, of course, leave Larry's contact information in the show notes. If anybody would like to reach out to Larry to ask questions on anything related to U.S. tax and living or purchasing in Israel, Larry will be available, obviously, to answer questions and help people out. Before we end, Larry, I'd like to just ask you a couple of questions.
Of course.
We already mentioned that we know each other from Modi'in, but tell us a little bit about Modi'in. Why are you here? What do you love about it?
I love the mix of people. It's a combination of religious, not religious, English-speaking, non-English-speaking. Everyone I've encountered here in Modi'in is really just nice. Everybody looks out for one another.
Oh, nice.
My neighbors are wonderful. They're non-American, non-English speakers, and, they're like family.
So special.
It's unbelievable. The education system here was one of the main reasons we decided to move here.
How long are you here for?
15 years ago.
You came straight from
New York. We were in Riverdale for 10 years before that.
Mm-hmm.
the school system was a main factor in deciding to move to Modi'in.
I've mentioned this before. A lot of the guests that I bring on happen to be from Modi'in. Obviously, it's convenient. By the way, I do all my interviews. I try and do them all face-to-face. I like to meet the people in person. But I don't do it just because it's convenient that they live in Modi'in. They are just really, really high-quality, educated professionals and good people here, like Larry.
I can't say it better. I can't say not about the Larry part, but about the type of people in this city. It's
quite unique.
It's very unique. It's got its own flavor to the city.
Very much so. And the Israelis are of the same caliber, really a good,
definitely
high quality, like whatever you need in any industry, you can find connections here in Modi'in. Medical and governmental, political,
everything.
Whatever you need, you can find it.
You would be surprised by the number of also what I would call closet Anglos, people who are Israeli, but second generation parents after
Definitely.
They made Aliyah from an English-speaking country.
Yeah.
A lot of English speakers that you would never peg as English speakers until you get to know them.
Interesting. So. Yeah, absolutely. Okay, and finally, Larry, if you were to move to a different part of the country, where would you go and why?
Well, my wife would say we need to move to the beach because that's where she wants to retire. But in terms of another place in the country, it's Ramon. I love nature.
Nice.
We love nature.
Down south.
We love nature. We love hiking.
How lovely. Well, let's hope that, please God, our country will be restored to safety and security very soon, and we should all be able to hike and enjoy. Everybody from all over the world should be able to come here, visit, stay, and feel very, very comfortable. Bezrat Hashem.
I sure hope so. Bezrat Hashem.
Larry, thank you so much for joining us, and thank you to our listeners for listening, and stay tuned next week for our UK counterpart to answer all the same questions.
Thank you for having me.
It's such a pleasure. Thank you. Thank you for listening to On the House. If you enjoyed this episode, make sure to subscribe and share it with your family and friends. You can also visit Buyitinisrael.com, where you can find news, market updates, guidance, and much more on real estate in Israel. That's Buyitinisrael, Buyit in Israel.com. If you have a question or a specific topic you'd like us to cover on this podcast, please email us at the address you'll find at the bottom of the show notes. Whether you're thinking about Aliyah, looking for a home or a haven, or wanting to support the Israeli economy, now is the time to buy it in Israel.